Welcome to part 2 of the latest podcast from the Gold Chronicles with Jim Rickards and Alex Stanczyk, presented by Physical Gold Fund.
I'm going to continue this conversation a little bit in regards to the gold market. And something that you said just a few minutes ago, Jim, that I think is really interesting is that these shortages are going to continue and probably continue to get worse. And I think you're right on the mark in regards to that. I think a lot of the market is well aware of how gold has been moving from the west into the east, largely into China and India. The demand from China going back over the last probably 5 to 8 years has been continually getting stronger. And something that a lot of people may or may not know, if people are familiar with sort of the gold story and follow the gold markets, they might already know this. But there are a lot of people who are taking a look at gold who've never really considered it before. And something that's important to point out is that gold that goes into China is like going into a black hole. And what I mean by that is that once the gold goes into China, I don't expect that we'll be seeing it anytime soon, and maybe never, because China does not sell its gold into the market. The only gold that ever comes out of China, I saw an article the other day that some was smuggled out, but China doesn't sell its gold on the world market. It sells it internally, and any gold that is sold from the private sector, according to the law in China, has to be sold to the People's Bank of China, which is the China Central Bank. And I also concur with what you were saying in regards to when Chinese official buying is going on. This is the Chinese Central Bank. They don't report those figures. And, I've suspected that for many years. I mentioned it in an interview that I did a couple of years ago, that I don't think we really had any kind of official way to measure the central bank's demand. The important part of the whole black hole issue is that over the years, as the West has been selling off, and you can measure this just looking at gold flows. Like if you pay attention to gold flowing from countries like the United States, countries like the UK, where the majority of the gold is held for the largest Western ETF gold funds in the world, and just watch where it goes as that gold is drawn down. When those big ETFs sell off, the gold leaves the United Kingdom. It goes through Switzerland. It gets re-refined into 1 kilo, we call it 4 nines fine, meaning 999.9 parts per thousand pure, which is the Chinese requirement. And those bars get shipped over to China. And there has been a lot of speculation that at some point those bars would come back on the market. We'd see big 400-ounce bars reintroduced into GLD inventory, things like that. But that hasn't happened. So that's pretty good proof that what's really happening when the West sells off its gold is that it's moving through Switzerland into China. There's been a really interesting dynamic that's occurred since the end of Q4 2016 to today. And that dynamic is yesterday, GLD had its first gold inflows into inventory since November 2nd. And for those of you who are not familiar with it, GLD is a Western gold ETF. It's sort of like the flagship gold ETF. It's run by bullion banks. So bullion banks are some of the largest banks in the world. That includes banks like the 5 market-making members of bullion banks are HSBC, Goldman Sachs, Citibank, JP Morgan, UBS. So sort of the regular suspects there. But the reason this is so interesting is that one of my colleagues just recently mentioned to me that the GLD inventory is way down, which is true if you measure it from the peak of 2016. But the truth is that as the gold price, USD gold price I'm talking about, passed through 1180 or so, the previous 2 times it did this, the inventory was 100 tons less than when it did this time. Okay, so said another way, what that means is that GLD had a 100-ton buffer that authorized participants didn't sell or didn't release into the market, which tells me that bullion banks were considering gold oversold and that it was going to reverse, which is exactly what it did. From the last time we had this webinar last month and we were talking about this. So what accounts then for the rise in the USD gold price back to 1200 if GLD inventory wasn't moving and if the West wasn't buying? What it means is that the slack was picked up by other major non-Western demand spheres. So we're talking China, India, before the West started buying again. And that's really just been in the last couple of days. So why this is important is that GLD is a pretty good proxy for measuring Western demand, measuring Western buying. And in particular, it measures hedge funds and speculators. So when you have a lot of speculative buying, or hedge funds are entering the market looking for price gains on the price of gold moving, they typically use GLD as the vehicle to do that. In 2016, there was a big run-up in the gold price, obviously, and that was driven mostly by Western speculators. So that went up to a peak. Obviously, these hedge funds all exited towards the end of 2016, and that brought the gold price back down to around $11.29. But here's the interesting part. Strong hands took the gold price back up to about $1,200 with pretty much no help from hedge funds. And what that means to me is that Western speculators weren't involved bringing this price from $11.29 back up to $1,200. Yes, there is a market vector where the USD is a pretty strong lever on the gold price, and the way you can measure that is if you watch the USD price when the USD price is, or the US dollar is strengthening and all other currencies are weakening against it and vice versa. That's a pretty strong vector. The indication here is that this has happened without a lot of help from Western speculators, and what that means is as that inventory was running down and moving over into China, into the black hole, so to speak, all that gold that went over there is not going to be available the next time the hedge funds, et cetera, are jumping back into the market. And I suspect most of that went mostly to China because India was off by some 400 tons from normal demand in 2016. What it means to us is that when Western speculators do step back into this market and that gold is not available, if the beginning of 2016 is any indication of tightness in the market, I think that the next time the hedge funds and speculators from the West step back into this market, it could be pretty energetic.
Thanks, Alex. That's a fascinating analysis of the gold story. Jim, at the end of our last podcast, we began a discussion on the war on cash. And I know your time today, and I totally understand, is a little bit limited, but could you give us a bit of an update on this phenomenon and perhaps place it in a wider context of global systemic risk?
Well, in my, thanks, John, in my most recent book, The Road to Ruin, which came out November 15th, I had a large section on the war on cash, and this has been going on for some time, and I expected it to get worse. I did not expect it would get so bad so quickly. That literally the week my book came out was when Prime Minister Modi of India announced basically the two largest circulation bills in India, the 1,000 rupee note and the 500 rupee note. He just woke up one morning and said they're illegal. They're no longer legal tender. And he said if you have them and you want your value, come on down to the bank, hand them in. We'll put money in your account. And if you need a little currency, we have a new 2,000 rupee note. It sounds good. It was a complete fiasco. About 80% or more of the Indian economy was run with paper currency. It's a 1.1 billion people, and they're over 80% cash. That's just the way a rural agrarian society works. Now, there is a middle class of 200 to 300 million people, and yeah, they've got their debit cards and their credit cards and their iPhones and their PayPal and all that other good stuff. That's fine for them, but what about the other billion people, or almost billion people, left out in the cold? Well, there were long lines of banks, the economy shut down, there were riots, there were supermarket shelves were stripped. They even screwed it up worse than that, which is the new 2,000 rupee note. They printed them. It was the wrong size. It didn't fit in the ATM machine, so they had to shut down all the ATM machines in India and rip the guts out of the physical machinery, not the programming, and change it so it would dispense these new 2,000 rupee notes. So it was a complete and utter disaster. Right after that, Venezuela says the 100 Bolivar note is worthless. Now, it was already kind of worthless anyway. It was, I think it was worth maybe 6 cents or something like that. But whatever the value, wasn't worth very much. But those notes had to be handed in. And of course, they always say this is designed to get rid of the black market, aimed at tax evaders and terrorists. They always have this list of excuses. But the truth is, it's aimed at everyday people. It's designed to force them into digital payment systems. Why? So that they can be slaughtered with negative interest rates, confiscation, freezes, etc. And this is not confined to just a few countries. It already happened in various ways in Cyprus, 2013, Greece in 2015. We've just seen it in India and Venezuela in recent weeks. Australia has started a parliamentary debate about getting rid of the 100 Australian dollar note. Europe last year got rid of the 500 euro note. Calls in the United States to get rid of the $100 bill. So this is not going away. This pressure is going to continue. We expect to see more of it. And again, it's forcing people to basically put their savings into some digital form. Now, it could be a bank account. Maybe you want a money market fund. By the way, I consider the phrase money market fund to be one of the great misnomers of all times because it's not money. People think it's money, but it's really a mutual fund of a particular kind where you have to call your broker and have them sell your shares and wire the money to your bank account. Well, sounds easy, that's what people do on a day-to-day basis, but what happens if the broker's closed? What happens if the exchange is closed? What happens if the bank is closed? What happens if the fund suspends redemptions? I mean, there are just so many ways for that to go wrong. It's not even close to money, but they call it money market funds because it makes people feel good, I guess. The cash component of your portfolio is definitely at risk. It's being forced into digital form so that it can be frozen or confiscated in various ways. And there really is no solution to it except to get out of the digital system. How can you get out of the digital system and still have some form of money? Well, my answer would be gold or silver. Gold is excellent for larger stores of wealth. Silver is excellent for a kind of, in effect, walking around money or transactional money. If you were in a power grid outage or social unrest or a natural disaster, people tell me all the time, well, you can't eat gold. Well, why would you want to eat it? If I went to buy food, I'd rather give you paper money and keep the gold. But in extremis, when paper money's not around or it's not valuable, you can't get it, or you're locked into a digital system which is frozen, I guarantee that people will sell you food or whatever you need for gold or silver. So and again, silver is practical for that purpose. You should, again, my recommendation has always been 10% of your portfolio, not all in, not 50%. If things get to the levels which I expect, and I fully do, gold at $10,000 an ounce, silver at $100 an ounce or more, and these other extreme scenarios playing out, then 10% of your portfolio will, in effect, insure the rest of your portfolio. You can do more if you like. That's an individual choice, but I'm comfortable with the 10% recommendation. That way, if things go the other way, which is always possible, a deflationary vector cannot be ruled out. Gold, could go lower, and you won't be hurt too badly if you have 10%. But even there, I would caution that a lower dollar price for gold doesn't mean a lower real value for gold. The real value of gold could be going up in a highly deflationary world. You might find that gold's going down from 1,200 to 900, but everything else is going down even more. So gold would actually preserve value better than stocks and bonds and some other trades. So don't get too hung up on the nominal price. Focus on the real price. Right now, the real price is rallying very strongly. Expect that to continue. But even if it goes the other way, a lower nominal price would be probably indicative of deflation, which could mean a higher real price. So you win either way. People say to me, gee, I don't understand gold, or gold's a barbarous relic. How could you put any of your portfolio into gold? And I just say, how could you not? I mean, how can you sleep at night not having some of your wealth in a non-digital form where it can't be wiped out by Vladimir Putin or frozen by some future administration? So, yeah, the war on cash is alive and well. It's getting worse. It's coming to a country near you. I expect the U.S. will join in sooner than later. And the only alternative is to get out of the digital payment system, and that means some tangible asset. You can have land and fine art and natural resources. Those are all good portfolio allocations, or non-digital contractual assets like private equity funds or venture capital funds, et cetera. But you definitely want some gold and silver.
Well, thanks, Jim. And now, Alex, we do have to let Jim run to his next appointment at 10 minutes before the hour today, but let's take at least one or two questions from our listeners.
Okay, sure. We've got about 5 minutes left right now. One question that's come in is from Andrew C., and he says, I love the work and the podcasts. I think his question is in regards to whether the IMF SDR is effectively money for people or if it's more money for sovereigns. His question directly is, if the IMF becomes the entity that bails out central banks by printing SDRs, is this effectively the IMF printing U.S. dollars, JPY, British pound, RMB, and euro directly? And if so, does the IMF need the permission from countries' central banks to do this?
Great question. Let me break it into a couple parts. First of all, when the IMF issues SDRs, they need a vote from their executive board, but presumably they would all be on board. They're not going to do this on like a normal sunny day. They're going to do it the next time there's a liquidity crisis of the kind we saw in 2008, which I do expect sooner than later. But in that crisis, the next one will be bigger than the central banks. The central banks won't be able to bail us out the way they did the last time. So everyone's going to turn to the IMF for the bailout, and the IMF will accommodate by a massive multi-trillion SDR printing. So they don't need central bank approval to do that. I mean, no doubt there'll be some phone calls behind the scenes, and they're going to talk to whoever it is, Janet Yellen or Mario Draghi or Kuroda-san or whoever. But they're a separate institution. They can act on their own, and they will. Now, when they do this, are they printing out bundles of yen and dollars and sterling? No. They're printing out SDRs. Now, people think that those SDRs are backed by those other currencies. They're not. There is a reference, so-called basket. I don't think basket is the right word, by the way, but people call it a basket. There is a five-currency basket: dollars, yen, euros, sterling, and Chinese yuan as of last October. That's related to the SDR. But that basket only exists for the purpose of calculating a cross rate. So if you say, well, what's an SDR worth? How many dollars is it worth, or how many yen is it worth? Well, there's a way to do that calculation, and those five currencies are in the calculation, but it's really a math problem. I mean, I get an email from the IMF every day with that day's SDR fixing, but right now it's about $1.50, a little bit less, but that's why those currencies are there. But when you print SDRs, you're just printing SDRs. Now, second part of the question: do they go to us? No, people don't get them. Countries get them. Basically, 189 members of the IMF, and they all get them in accordance with their shares in the IMF. It's like stock in the company. The U.S. is about 16% of the votes at the IMF, so if they printed 10 trillion SDRs, the U.S. would get 1.6 trillion SDRs, and so on. Everyone would get their share based on their vote. But then from there it gets interesting, because a lot of countries will get SDRs, and they'll say, well, thanks, but I don't really need SDRs. I need euros, or I need dollars, or because I've got trade deficits, or I've got external financial obligations I can't finance, or my corporations can't roll over their debt, they're going bankrupt, I need to bail them out, etc. And there is a trading desk inside the IMF, and if you have SDRs you don't want, and you need these other currencies, you can swap them. You can sell SDRs for the other currencies. So you can get the other currencies to pay your bills, but they're coming from existing supplies. They're not newly printed dollars, they're just dollars that are there from the United States or elsewhere. So that's how countries get liquid currencies, but it's not that the IMF's printing dollars and euros, it's that they're printing SDRs, and people who get them can, in effect, sell them through a trading desk in the IMF to get dollars. Now, who's the buyer, right? So if I'm Hungary or Zimbabwe or anybody, and I want to sell SDRs because I need something else, who's buying those SDRs? Well, one buyer is China, and China's buying the SDRs because they're trying to get out of dollars. So there's a big, kind of game of musical chairs going on here behind the scenes, and these values can fluctuate. But one thing for sure, I mean, I don't need to get too down in the weeds in terms of a technical lecture on how the SDRs actually work. But one thing is certain: this will be inflationary. I don't care if you call it, SDRs or banana peels. If you print 10 trillion or something and give it to all these countries in a way that they can spend it, then that's going to be inflationary, and that's extremely bullish for gold. I mean, it's super bullish for gold. So I see two endgame scenarios. One involves actually going to a gold standard, which I'm not predicting, but if they did, then that would mean gold at $10,000 an ounce. It has to be $10,000 an ounce, because any lower price is deflationary, which is the last thing you want. There's math behind that. Or if they don't go to a gold standard, they're going to have to go to SDRs, which is just inflationary, which means the dollar price of gold will go up. So gold goes up either way in this scenario. There are some efforts at a private SDR market, what the IMF calls M-SDRs, M-SDR. M stands for market. That market's taking off. They have a 10-year plan to do that, but in my view, they're not going to get that far. This crisis will come before they finish their 10-year plan, and then they're going to have to go to SDRs on an emergency basis rather than a gradual basis, and then that's just going to be the response to the the next financial panic.
Well, I think we have to let Jim go now. I'm sorry, everyone, and we'd love to hear more of your questions, but today, as you understand, Jim is in huge demand from many sources for his insights, and we're very privileged to have him each month for this long. And so thank you, Jim Rickards, and thank you, Alex, also for your very insightful analysis today. It's always a pleasure and an education sharing this time with the both of you. And most of all, thank you to our listeners for spending time with us today. Let me encourage you to follow Jim and Alex on Twitter. Jim's handle is at James G. Rickards. Alex's handle is at Alex Stanczyk. So goodbye for now, and we look forward to joining you again soon. You have been listening to The Gold Chronicles with Jim Rickards and Alex Stanczyk, presented by Physical Gold Fund. Recordings can be found at physicalgoldfund.com/podcasts. You can register there for news of upcoming interviews with Jim Rickards and other world-class thinkers.